Every crash feels different until you see it through the eyes of smart money. The headlines scream chaos, fear grips the crowd, and retail traders sell everything that moves. But the professionals? They're calm, patient, and already positioning for what comes next. Because they're not guessing. They're following a strategy that works in booms and busts and in everything between. Tonight, we're breaking down the smart money strategy that wins even when the world falls apart. Let's start with a simple idea. Markets crash not because investors run out of money, but because they run out of trust. Liquidity vanishes, fear dominates, and prices detach from fundamentals. Smart money knows this, and they wait for that moment. Because when emotion peaks, opportunity begins. To understand this, you need to know who the smart money really is. It's not a secret club. It's the institutions, hedge funds, family offices, and deep-pocketed traders who think long-term but act fast. They don't chase trends, they anticipate reactions. They don't panic, they prepare. While the crowd watches CNBC, smart money watches liquidity. They track positioning data, volatility spreads, and cross-asset correlations. They don't ask what happened. They ask who is trapped. When volatility spikes, margin calls start. That's when smart money steps in, not to predict the bottom, but to measure exhaustion. They use one core principle. Liquidity stress creates forced sellers, and forced sellers create mispriced assets. Here's how it plays out. During every major crash, 2008, 2020, 2022, assets that shouldn't move together suddenly collapse in unison. Correlations go to 1. Gold, stocks, crypto, bonds, everything sells off. Why? Because when margin clerks run the world, fundamentals don't matter. Liquidity does. Smart money watches that moment like a hawk. They wait until panic selling turns mechanical. Then they start accumulating, not all at once, but in layers. Quietly, gradually. They don't try to pick bottoms. They buy exhaustion. They look for signals. Volatility turns structure flattening, meaning short-term fear is subsiding. Credit spreads peaking, fear in funding markets reaching extremes. Capitulation volume, when daily turnover spikes, that's not conviction, that's despair. And here's what they know that most traders don't. Crashes don't destroy wealth, they transfer it. From emotional money to disciplined money. From noise to signal. The smart money strategy works because it's built on 3 timeless principles: patience, positioning, and psychology. First, patience. The pros don't chase rebounds. They build exposure over time. They understand that bottoms are processes, not moments. They don't care about catching the exact tick. They care about risk-adjusted entry. Second, positioning. They use derivatives and volatility to their advantage. When fear explodes, options get expensive. Smart money sells that fear, collecting premium when everyone else is buying panic. They sell volatility, hedge exposure, and turn chaos into cash flow. Third, psychology. They know most investors can't handle pain. So when retail traders capitulate, dumping positions, canceling limit orders, exiting at any price, that's the buy signal. Not because they're cruel, but because discipline always outlasts emotion. The irony? The same investors who panic during crashes are often the ones who pile back in at the top. Smart money simply does the opposite. But let's be clear, this strategy isn't about being fearless. It's about being prepared. Smart money knows the system, the liquidity flows, and the triggers. They expect volatility. They plan for it. They watch for what retail never sees: dealer gamma exposure, CTA positioning, credit default swaps, basis spreads. When these indicators unwind, it tells them where the stress is moving next. They don't predict the news, they predict the reactions. Take March 2020. As markets imploded, retail panic sold ETFs and mutual funds. But institutional players started accumulating investment-grade credit, backed by the knowledge that central banks would step in. When the Fed launched its bond-buying program weeks later, those positions exploded in value. Same in 2022. As the Nasdaq crashed and tech stocks bled out, smart money rotated into energy, commodities, and defensives. They didn't predict inflation, they read positioning data months ahead. It's not magic. It's math. They watch the flows. They map the pain. They buy where the panic ends. And when the recovery comes, because it always does, they're already in. Now let's get practical. How can ordinary investors think like smart money during volatility? Number 1, track positioning, not price. Use tools like COT data, ETF flows, and volatility indexes. They reveal where leverage is stretched and who's most exposed. Number 2, follow liquidity, not headlines. Crashes happen when liquidity evaporates, not when news breaks. Watch credit spreads, repo rates, and funding stress indicators. Number 3, stay patient. You don't need to buy the dip, you need to buy despair. Wait for exhaustion signals, volume spikes, volatility peaks, and sentiment collapse. That's when probability shifts in your favor. Number 4, manage risk through diversification of time, not just assets. Build positions over weeks, not hours. The crowd wants instant gratification. Smart money wants survival. And finally, number 5, understand your edge. Smart money doesn't need to be early. It just needs to be right when the dust settles. Because markets don't reward bravery. They reward discipline. When crashes happen, most investors look for exits. Smart money looks for entries. That's the paradox of the market cycle. Chaos is not an ending, it's a reset. The players change. The rules stay the same. The smart money strategy isn't about predicting crashes. It's about being the last buyer standing when everyone else is selling. It's not glamorous. It's not fast. It's not clickbait. But it works every single time. So the next time the market falls apart, remember, fear is temporary. Capital is permanent. And the traders who understand that, the ones who treat panic as opportunity, are the ones who write the next chapter. If this helped you see how professionals turn chaos into opportunity, make sure to like, comment, share, and subscribe, because next time we're going inside the psychology of how smart money spots panic before it even hits the charts.